Hello everyone, I'm Nitesh, pursuing my final year engineering, the domain of ISC at SVC. This video is on my technical seminar. The topic is empirical research on multi-factor quantitative stock selection strategy based on machine learning and under the guidance of Guru Prasad YK, Assistant Professor, SVC. The contents of the topic are introduction, related background, related tables, implementation, future enhancement, conclusion, and the references. Moving on to the introduction, quantitative investment can capture more investment opportunities because of its diversified quantitative model, wide observation perspective, and massive data analysis. It can overcome the subjective judgment bias of investors by using quantitative thinking for investment trading. Machine learning has been able to quickly analyze, fit, and predict massive data with the rapid development of artificial intelligence. The relationship between artificial intelligence and quantitative trading is becoming closer and closer. Quantitative investment identifies and describes development and change law of financial market by constructing quantitative methods and models. We use computer technology to replace people in complex investment operations such as transaction decision making and risk control, which effectively overcomes the inevitable experience, emotion, and energy defects of traditional manual investment. Moving on to the related background, quantitative stock selection is to use quantitative methods to select a stock portfolio, hoping that the stock portfolio can obtain investment behavior beyond the benchmark rate of return. The research shows that the most profitable model of sector and industry rotation, the transaction of institutional investors, is periodic and defensive rotation allocation based on the industry level, which is also the most commonly used strategy of institutional investors. Multi-factor model is the most widely used stock selection model. The basic principle is to use a series of factors as stock selection criteria. Stocks that meet these factors are bought and those that are not satisfied are sold. The multi-factor model is relatively stable because there are always some factors that will play a role under different market conditions. Moving on to data tables, there are three columns: factor name, computing method, as well as factor description. The first factor is market value. Its computing method is total market value that equals share price multiplied by total share capital, and its description is that it reflects the total size of the enterprise and including information such as share price and share capital. The next factor is equity. Its computing method is report subjects as well as see accounting statements for details. The description of factor name, that is equity, that is that it reflects the total scale of circulating shares of the enterprise. The third factor is EPS. Its computing method is current net profit divided by weighted average of common shares. And its description is that it reflects the business performance of the enterprise. The fourth factor is PE, and its computing method is market value divided by current net profit. The description of it is reflects the value of enterprise. The next is turnover. Computing method is trading volume divided by total shares. Moving on to the second table, it has three columns as the previous table. The three columns consist of factor type, factor name, as well as factor description. Factor type, the first factor type is valuation, and the factor name given to it are EP and BP. The factor description of this is earnings yield expressed as the reciprocal of PE ratio, book to market ratio expressed as the reciprocal of price to book ratio. The second factor type is capital structure. The names given are LEV and CMV. Factor description is financial leverage is expressed by the ratio of total liabilities to total assets. Logarithm of circulating stocks market value. The third factor type is profit. Factor name is NI slash P and NI for N. The net profit margin is expressed by the absolute value of the ratio net profit. The third table consists of four columns. There is algorithm, algorithms used in the paper and in the model: factor combination, yield percentage in terms of percentage, as well as maximum drawdown. The first algorithm is support vector machine. Factor combination for 1, the yield is 87.45%, and the maximum drawdown percentage is 38.68. And factor combination for 2, the yield obtained is 76.38 percentage, and the maximum drawdown percentage is 40.56%. Then algorithm, the second algorithm used is gradient lifting regression. The factor combination for 1, we have obtained the yield 68.56 percentage, and the maximum drawdown percentage is 42.36%. Then for factor combination 2, the yield is 60.38 percentage, and maximum drawdown percentage is 40.21. And the third algorithm used is random forest. The factor combination for 1, and for 1 the yield is 72.36 percentage, and maximum drawdown percentage is 45.26. And for the factor combination 2, the obtained yield is 69.45%, as well as maximum drawdown percentage is 40.28. Moving on implementation, market value is the key content considered by the stock indexes in the process of selecting the tracked sample stocks. So the share capital is added to the preliminary factor library. Considering the general nature of these individual stocks, profitability, net profit growth rate, valuation, turnover rate, and other factors are preliminary added. Obtain the data of sample stocks of CSI 300 index on each trading day from Jan 1st, 2013 to June 30, 2021 as an empirical sample. The factors in Table 2 are selected as candidate factors by comprehensively considering the correlation of the above factors and considering the aspects of value, capital structure, profitability, and growth respectively. By regressing multiple factors in Table 2, the smaller the residual value, the more serious the downward deviation of the stock market value from its theoretical value. This paper uses around 3 to 4 machine learning algorithms like support vector machine, gradient lifting regression, random forest, and linear regression. Future enhancement. This slide is about future enhancement. In the future, researchers can focus on combining sentiment analysis of stocks, related information, and numeric value associated with the historical value of stocks in predicting stock prices. Further effective stock recommendation systems can also be built by leveraging both information. Deep learning based approaches can be further exploited for better and efficient feature extraction techniques. Graph knowledge approaches are promising solutions which can be used for building prediction engines. However, research works should address the complexity and gradient of graphs with large number of nodes. Our survey gives insights on future research directions in this area. Moving to the conclusion part, machine learning algorithm is an important method to mine stock selection factors and efficiently construct quantitative stock selection strategies. Firstly, through the layer by layer screening of multifactor, two groups of multi-factor combination are obtained. Combination 1 is the market value and equity combination, and combination 2 is the turnover rate and equity combination. Then, using the data from January 1, 2013 to June 30, 2021, the alpha strategy is used to estimate the parameters, construct the portfolio, and study the investment return of the portfolio during the hedging period. Thirdly, after obtaining the multi-factor combination, this paper makes an empirical study by using 3 to 4 machine learning algorithms such as support vector machine, gradient lifting regression, random forest, or or a linear regression to explore whether the multi-factor stock selection strategy under different machine learning algorithms can obtain better investment effect. Moving on to the references. The first reference is Sumi Liao, Yang Kong Sun, based on does financial technology innovation promote enterprise transformation. Evidence from China Technology and Society 2022. Next is Christian Borch, Machine Learning Knowledge Risk Compensable Agent, Problems in Automated Trading, Technology in Society 2022. Next, the third reference is Shirley Camponeer, a big data state of mind, epistemological challenges to accountability and transparency in data-driven regulation, Government of Information Quarterly, 2021. The fourth is Xing Zhao, Financial Technology Innovation, Regulation based on reputation theory with the participation of new media, 2021 journal. The fifth one is Elisa Chiaretta, The Determinants of Debt Financing, the case of financial technology startups, Journal of Innovation and Knowledge, 2021. Thank you.